All right, so I'm going to show you how to know if a rental property is a good deal or not. My name is Sean Price. I'm with eXp Realty, and I'm about to dive into a current property that is on the market. And I'm going to do a live rental analysis so that you can see if this property might be a good a rental investment property. More importantly than the specifics of this property, I want to show you how we analyze a property and how that translates into the four different benefits of owning real estate, especially as an investment property. You've got the tax benefits, you have appreciation, you have depreciation, and you have potential cash flow. So we're going to go through this full analysis. We're going to go through all of the tax benefits after we do the analysis, and then you can judge for yourself if this is a good property for you or not. All right, so let's get right to it. Okay, so my goal for this property is to demonstrate um, how we can quickly analyze a property using public information so that we can determine whether this is a good investment or not. And remember, determining whether an investment is a good investment or not is strictly based on the criteria of what you're looking for. So if your goals are, um, cash flow, that's one factor we look at. Are your goals based on what your total annual return on investment is, including appreciation? Well, we're going to look at that as well. So it depends on what your values are. Or what your goals are. So this property is specifically picked from Zillow so that we can use Zillow information. I am going to have to pull some additional information for this, but I'll tell you about that as we go. Okay, so this property is a property that's currently for sale on the market. It's a two-bedroom, one-bath condo for 905 square feet. So first thing we do is we put in the sales price of 219,900. I'm sorry, 219,990. Cannot type. And then the computer is going to automatically calculate the down payment, which is 20% for this. Sometimes it can be 25%. It just depends on what lending programs you can get into. It's also going to calculate your closing costs, estimated at 3% of the sales price. So that's $65.99. Looking at the pictures on this property over here, you can see it doesn't look like there's much that needs to be done with regards to repairs. So we're going to leave that blank. So that leaves you a total cash that you're going to put into this property of $50,597.70. Now, this is one of the benefits about real estate. You're buying a $219,000 asset, but you're only investing $50,000. So any calculations on return on investment is not going to be based on 219. It's going to be based on your 50,597. So that's what the benefit of leverage is with regards to real estate. The other benefit to this is, let's say that you were doing this as a first-time home buyer, or you were buying it personally. You could put maybe 3% down, or 5% down, or 10% down. So your cash invested would be significantly less. You live in the property for a year, and then you turn it into a rental property, and you now have an income producing property with much less cash invested. So those are the basics of the down payment and how that's calculated. So your financed amount is 175,992 in this situation. Financing rate with current interest rates, we're going to put about 7% in there. Total assessed value. So the reason we want to have these numbers is for the calculation of depreciation. So I'm going to show you the benefits of depreciation as we go through this process. You will need to consult with a tax professional to help you determine if you can use depreciation and what you can do with that. Okay, so that I looked this up. So if you want to look this up live while you're doing this, you can always go to the Alexandria City website and type in the address and pull up the tax data. I've already looked it up just for the sake of saving time. And so we have $187,000 is the total assessed value, and the land that cost value is $37,000. So that amount gives us what is depreciable, because you can only depreciate the improvements. So it would be this amount, and it would be calculated over, I believe they depreciate over a period of 27 years. Again, talk to your accountant. They can give you strategies for, there are a couple different options for depreciation schedules, but this is just a general depreciation schedule. You would take this amount, divide that by, again, I believe the number is 27, and then be able to depreciate that amount each year for against the income. Annual real estate taxes for this property are 69.84 per year. Oh, I'm sorry, nope, I am incorrect on that. Hold on, I gotta go over here. I've got the taxes pulled up on a different screen. Bear with me. I apologize for the delay here. I thought I had this written down over here. $21.60 per year. $21.60 per year. So those are the annual real estate taxes. We're not doing any personal property on this. We're not having to put in furniture or appliances or anything like that because they're all included and they all look they're in good condition. Land improvement costs, these are things like if we were adding a pool, a deck, fencing, something like that, because those are not depreciable. That's why we put them down here. We're not going to be doing that because this is a condo. The monthly rent on this. So in Zillow, quite often, if you go down here, this is where you can find a lot of the costs as well. So, for example, your property taxes at $180 a month. That's where we can calculate. Let me confirm. They calculate property taxes differently on Zillow, but since we're demonstrating it being done through Zillow, we're going to do that. So 180 times 12 is 2160. Okay. The monthly rent, typically on Zillow, right in here, you're going to have what's called a rent estimate. They don't have it for this property, so I did some research before starting the video, and I'm going to say about $1,900 a month on the rent estimate. So once you put that in, then the computer is going to automatically calculate property management. I have that at 12%. There are a lot of property managers right now that will operate at 8%, so this could be significantly lower. I like to be a little bit conservative on these. So that would be your property management fee. And then CapEx savings. This is savings set aside out of each month's rent in order to be able to protect your, to make sure you have cash on hand in case a water heater breaks or an air conditioner. Since it's a condo, you don't have to worry about the roof. But you might have to worry about replacing windows at some point. So that's what this is saving up for. If it's a house, then you're thinking about roof, you're thinking about home repairs, things along those lines. Repairs for the year, none of that is going to be an issue for this. So association fees up here, I didn't put this in here. And here's one of the challenges with Zillow when you're trying to do this just using Zillow is when you come into Zillow, sometimes they'll have HOA fees and it'll say NA. And that's because the way that it's put into the multiple listing service is these aren't HOA fees, they're condo fees. So this unit actually has condo fees of $582 a month, which comes out to $69.84 per year. So we need to calculate that in because that's going to be a cost that we're going to have to cover. And then the last thing is property insurance, and we're going to use Zillow's example for that. So homeowners insurance, so $77 per month comes out to 77 times 12, $924 per year. Okay, so those are our basic inputs, and we're going to assume a tax bracket of 35%. We're going to assume a top tax bracket in our calculations. All right, so we're going to go over to the actual property. So these are the benefits of investing in real estate. We call them the 4 benefits. First one is cash flow. Okay, so based on the numbers that we drew up in here, you will see that cash flow is going to be extremely negative on this property, over $700 a month almost. So negative $8,000 per year in cash flow. All right. Annual debt service. So this is one of the benefits I didn't mention in the original video, but as the tenant is paying the rent to you, they're also paying down your debt. So for the first year, they're going to pay off $1,787.74 of your debt. So that is a ghost profit for you. That is equity that's being built into the property. Tax savings. So again, you have to talk to your accountant, but based on an operating income, you're showing a net operating income of $12,862. So with that, net taxable income of negative $12,862. So what that's going to do is it's going to save you in taxes $4,500.
Okay, so this again, you need to talk to your accountant to make sure that they calculate this appropriately and make sure that you get the full tax benefit of this because you can deduct interest, you can deduct depreciation, you can deduct your net income, and that would get you to a point of $4,500 in tax savings. Okay, so technically your losses would be about $12,862. Appreciation is the fourth benefit. I like to put 2% in here. On average, appreciation year over year is between 3 and 5% in a typical real estate market. We're certainly not going to use the 17 to 20% that we saw in the last 2 years because that's just not normal. So I like to use 2%. So that would show an increase in value of 43.99. Okay, so taking these into account, your return on investment, again, this is a return on your $50,000 that were invested because you don't have to invest the full 219, so the $50,000, and yet you get to take full advantage of the appreciation on the full amount, the 219,000. So return on investment with appreciation would be 4.92%. If you take out appreciation, because some years you're not going to appreciate, some years you might depreciate a little bit, values may decline a little bit, then without appreciation, you're showing a negative return of negative 3.4%, a cap rate of 2.6. This is a number that is typically used in commercial investing to quickly determine if a commercial property is going to be a good transaction, and then also used to calculate how you can put forced equity into it. And then your cash on cash in this example is going to be negative 15%. So depending on what your financial goals are and depending on what your target return is, then that's how you determine if this property is a good investment. So as is, this property, in my opinion, this does not look like a good investment because you have negative cash flow. Without appreciation, you have a negative return here. So, you may or may not end up in the positive on this if you don't have appreciation. Now, over the long term, you're going to have a 4% return if you go year over year. So, you just have to determine, is this a good fit for you? And keep in mind as well, this is the first year. The next year, your debt pay down is going to be higher because year one or month one, you're only paying $144 to principal on that first payment. Month 13, you're paying $154 because as you move down the amortization schedule, you pay off more debt with the each payment. So this number will go up. So year two, these numbers are going to look a little bit different. So you would analyze it in year two and see how that's going to go. But for year one, this looks like it's probably not the best use of your $50,000. Now, do you need to calculate and keep all of these expenses in your calculation? So, for example, are you going to hire a management company or will you manage yourself? Well, if you're going to manage yourself, that changes the numbers. Repairs. Are this unit looks like it's been recently repaired. Are you comfortable just taking the money and using the money as you receive it and not necessarily setting the money aside for capital expenditures? If that's the case, then you would remove those. Vacancy. Are you comfortable not accounting for any amounts of vacancy? You can remove that. So the raw outcome of this property without putting money aside for a rainy day looks a lot different. So cash flow before taxes, you're at negative $1,300. So you're losing a little bit over $100 per month. Your principal reduction stays the same. Your tax savings goes down quite a bit because you're not losing nearly as much money on the property, but you're still saving about $2,081 in taxes, and your appreciation still stays the same. So when you look at return on investment now, you've got a return on investment with your appreciation is 12%. That looks a lot better. Your return on investment without appreciation, it would just flat out equity pay down and all these benefits up here, you're at 4.459%. Your cap rate goes up to 5.7%, and your cash on cash goes down to negative 2.3%. So if you're looking to invest and you want to get a minimum of a 10% return and you're okay losing, paying $100 a month to get that 10% return on the first year, this might be a good investment for you as long as you're comfortable not putting the money away for rainy days. If you know that you have cash liquidity enough to cover anything that might come up, this might be a good investment. So there are several ways that you can look at a property and several ways to analyze them and several ways to determine if it's a good investment. And the final determination comes down to each individual investor's criteria and what their goals are and what their goals for their portfolio are. So if you have any questions on this, please feel free to reach out to me. If you have a property that you would like to have analyzed, please feel free to let me know about that as well. And we'll see you on the next video.